Hello traders, welcome back to the Forex Geek where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about the RSI Swing Trading Strategy, a time-based approach that can help you identify market momentum shifts and potential reversal points. So by the end of this video, you would understand how to implement this strategy in your daily routine and recognize high probability setup that aligns with the market cycle. So we start by understanding the RSI swing trading strategy. The RSI simply means your relative strength index. The RSI is a momentum oscillator that measures the speed and change of price movement. In swing trading, the RSI proves particularly useful for capturing short to medium term price movement. Traditionally, the RSI reading above 70 suggests an overbought region, while a reading below 30 suggests an oversold region. However, in more volatile markets like your crypto, traders might adjust this threshold to 80 and 20 respectively to filter out false signals. So the RSI strength lies in the ability to reveal the market momentum shifts and potential reversal points. One key concept is to understand the RSI divergence. This occurs when price action and RSI indicator move in opposite direction. Meaning, for example, when the price action signifies a lower low, but your RSI indicator at this area is signifying a higher low. This is a divergence in price and it usually signifies weakened downward movement, indicating a bullish trend. So we have different kind of divergence where we have the bullish divergence, and this forms when price makes a lower low while the RSI creates a higher low, suggesting weakened downward movement, suggests that we will reverse to the upside. Conversely, a bearish divergence occurs when price makes a new high, it makes a higher high, and as we can see in this area, price made a higher high. But remember that the divergence occurs when the RSI makes a different structure compared to the price action. Price made a higher high at this area, the indicator will make a lower high. This is a divergence, and this indicates the fading away of the upward momentum, signifying introduction of sellers to the market. Another RSI signal is a failed swing. This pattern involves the RSI breaking its own support and resistance level. So how do we implement the use of the RSI for swings trading? To implement the RSI, it requires a systematic approach. To identify your high probability trading opportunity, your first step is to select the appropriate time frame for analysis. So for your swing trading, we'll make use of our 4-hour time frame. We begin by determining the prevailing market direction, which is in this case we are in an uptrend. Because the RSI signal are more reliable when they are aligned with overall direction of the market. So in an uptrend, you have to focus on oversold RSI conditions for potential buying signal. Conversely, in a downtrend, you pay attention for overbought readings for potential short entries. For long position, you wait for the RSI to drop below 30. So if you want to enter a buy trade at this area, you wait for your RSI to drop below 30. This is a typical example. At this area, it is below 30 hour mark on the RSI indicator. This signifies a buying opportunity, a good place to buy your trade. While in a downtrend, you look for price to be above 70. In a downtrend, when price is above 70, it signifies a strong selling pressure, and in this area it is above 70, and we can see that as above 70 is a good area for us to look for a short position. This approach captures the beginning of a potential downswing. Remember to always use proper risk management for a long-term success with this strategy. For long positions, you place your stop loss below the swing low like we did in this area. Your stop loss should be below the swing low, while in a selling trade, your stop loss should be above the swing high. Your exit strategy you should aim for at least 1:2 or 1:3 as the case may be. That should be your minimum risk to reward, 1:2 or 1:3. While you can also exit, you can use an exit strategy of taking partial profits early. You can take partial profits at 1:1 as the case may be. Additionally, you can use the RSI itself as an exit signal. You can consider taking profits when the RSI shows a sign of getting back in this selling opportunity. Remember, we are selling from when price is in an overbought region. When price moves in your direction and gets to an oversold region, this should be an exit strategy for use. You can also do that in a buying scenario. You can buy and exit when price gets to an overbought condition. Alright traders, we have come to the end of this